I'm just going to answer some questions that I received during the week. I received 2 questions. And the first question is hedging considerations. We've already done the role and importance of financial modeling in investment banking. That was Hedieh's section. The next is hedging considerations. And what is a prepayment, a royalty, and a streaming agreement? Okay. So the first question that I received is from a student, and he asked me, he's currently working in investment banking, sounds like on the M&A side, but he asked me, is there a stock standard market approach to telling a client how long to hedge for? Do you tell a client you're going to hedge your production for the next year, or is market standard to say 3 months quarterly, semi-annually? Is there some guideline because they want to advise a client? What's your starting point? How do you tell a client how long to hedge for? And I said you have to back solve. So you have to start with who is giving the client advice. Is the bank telling the client to hedge? Typically, banks want to hedge because they want to de-risk a certain project, or they want to achieve a certain outcome. So you have to look at who's giving the advice. And then the second thing you have to look at is what objective are you looking to accomplish? So the first thing is we usually hedge at the fair forward rate. So you look at the forward curve, and then that's what you're going to look at. So what are your objectives? If your objective is to de-risk the project, and you're looking at the forward curve projecting into the future, and the hedge prices that you can achieve, maybe the forward curve is downward sloping, it's in backwardation. That means that if you hedge for a long-term period, you're locking in lower prices. The longer you go out into the future, the lower the prices become. Whereas if the forward curve is in contango, upward sloping, then if you're locking in long-term prices, at least on the face of it, you're locking in higher prices in the future. But you don't actually know where the market will end up, but you're hedging according to a forward curve. So the first consideration is just know that you are going to hedge according to the forward curve, unless you want to use options. But option contracts, you need to pay a premium up front. So generally producers, especially in the mining sector, avoid hedging via option contracts because it's basically paying for an insurance product. So you're paying the premiums, and they want to avoid that cost. Whereas if you're hedging using forward contracts or futures contracts, the initial outlay is minimum to zero. If it's a forward contract, 0 initial outlay, 0 initial money going out, but you are locking in the price for the future. The next thing you have to consider, the tenor and the quantity. Those are the main discussion points. Okay. So again, let's just assume that your boss asked you to formulate a hedging policy for your customer or your client. Okay. So typically, if it's coming from a bank, you want to de-risk. In other words, you want to make sure that you have price certainty for a certain horizon going forward into the future. The 2 questions you have to ask yourself is, how much am I going to hedge? Okay, and how long am I going to hedge for? Tenor and quantity. These all depend on the model and negotiations with the client. Important point, clients typically don't want to hedge. They'll often push back against long-term hedging. Why? Because when a client starts a mine, for instance, a gold mine, what they're banking on is they have cash costs to extract the gold from the ground, and then they sell the gold at the market price. What they're banking on is, because it's a commodity market, the prices are cyclical. So you can get periods where the commodity price runs up. And what we're seeing nowadays with somewhat of a bull market in copper and gold is the gold producers are really making money hand over fist right now. So you can imagine if you were a gold mining company and the bank forced you into a long-term hedge last year, pre-2020. You would have missed out on all the upside with gold at now close to $1,800 an ounce, where last year it was $1,200 an ounce. So you're missing out on all of that upside if you had hedged in a long-term hedging scheme. You're basically thrown away all of that profit. So because as well, companies that are in mining are ever the optimists, they believe that a bull run is just around the corner. It's just going to climb around the corner. So they typically don't want to hedge long term, and they'll push back against this. Another consideration is the longer you hedge for. If you're hedging using forward contracts, there's something that's called credit risk there. And if I'm an investment bank, credit risk is the risk of you defaulting. So you have obligations. You have to deliver gold into this hedge. But if the hedge moves out of your favor, in other words, if you have to deliver at a low price, you've locked in prices that are low, but the market shows that prices are much higher than the price that you're locked into, it's advantageous for you to just walk away. And then you can then sell your gold into the market. So then there's a risk to me of you walking away from your deal because the deal is no longer looking good for you from your perspective. And we call that credit risk. What is the risk of you defaulting on your hedge obligations? Can you actually deliver into the hedge? If you're hedging a large proportion of output, maybe you're hedging 100% of output. What happens if somebody drops a spanner into the plant and you lose a month of production? You still have to deliver into that 100% hedge contract, so you have to source the gold elsewhere, or you have to pay. You have to get cash settled for that under delivery, that portion of the contract that you could not deliver into. So you look at all these things from the bank's perspective and you say, okay, this is the credit risk of this counterparty. If the bank views you as a high risk, then you might think that you're getting hedge prices at the forward price. You are, but the bank will then deduct a credit margin from the price that it actually offers you on your hedge. So you also have to bear that in mind. And generally speaking, the longer out you go, the higher those charges become. So to do a long dated hedge, the margin that you have to pay to the bank, just in terms of a risk mitigation for the bank, becomes bigger the further out you go. So you also have to think of cost considerations as well. Another question I gave him to ask, whether he's going to ask his boss this question or ask his colleagues who are working on the same deal, does the model indicate a weak project? In this case, hedging won't solve all of your operational problems, no matter how much you hedge. Okay? If the project is barely making it, and you say to yourself, okay, now gold is at $1,800 an ounce, we should hedge now because this is a very high cost producer. Well, that's risky. And there could be some other things that are tripping up that project. I would not rely on a hedge and hedge 100% of production if there are other fatal flaws in the project. You're going to run into a lot of problems down the line. If you're a high cost producer, maybe you should seek some operational cost efficiencies instead and focus your attention there. What are the fatal flaws of the model? Okay, you can't hedge away your problems, in other words. So there's a famous study of Ashanti Gold, and Gold Fields owned Ashanti Gold, and Ashanti Gold, this was about it was in the early 2000s. Ashanti Gold, when the gold price was still at about between $200 to $300 an ounce, they were a pretty decent producer, and they decided to hedge significantly all of their production. So their hedge ratio was about 80 to 100%. So they were hedging significantly all of their production, and the gold price climbed a bit. So let's just assume that their all-in cash costs were about $200 an ounce at that stage. And then the gold price was at $300 an ounce. Okay, you'd think, wow, what a prudent management team. They're locking in a healthy profit margin, and they're not greedy. They're not considering the potential upside of where gold could go. So all they want to do is just protect a certain profitability margin. It's a steady stock. I'm going to buy that share because I know what my profit margins are going to be going forward. Wrong. What happened was they hedged using futures contracts, and the gold price continued to rise. Now, futures are different from forwards. Under a forward contract, you're dealing with you and the bank, or you and the dealer. And all the obligation is if you are under a short position in a forward contract, you need to deliver your gold to me at a fixed price that we agreed to back in the day. Okay? You just have to deliver at that price. Under a futures contract, it's the same contract, but the only difference is you're dealing not with a bank, but you're dealing with an exchange. And the exchange does not want to take your credit risk. Remember, I talked about the risk of default, the risk of you running away when things get tough. The futures exchange does not want to take that risk. So what they'll have you do is when you enter into that futures contract, they'll have you deposit a notional amount of money called the initial margin into an account with the exchange. So you have to deposit a certain amount of money, and that amount of money is like a safeguard. Just in case you decide to run away, the exchange can take that money and settle the contract if the contract was adverse to you. So they can mitigate their losses. What happens every single day is, depending on where the gold price is, you will either be required to top up that account. So let's say the contract moved out of your favor. You locked in a gold price of $300 an ounce, but gold went from $300 to $350 in that one day. Well, that's very risky for the exchange, because you could then decide to walk away and say, okay, I'm going to walk away from this contract. Why should I sell my gold at $300 an ounce to this exchange when I can sell it for $350 to the open market? Let me just walk away from this contract and say, okay, I'll sell my gold for $350 in the open market, and goodbye exchange, I'm not going to honor my contract. So to protect against this, the exchange will say your account balance is sitting at X. The gold price has moved to $350 from $300 an ounce. There's an added risk of you walking away from this contract. We want you to top up your account. Put a certain amount of money into your account so that we're risk neutral at the end of the day, the exchange. If you walk away, we'll just take the money in your account and it'll cover any losses that we would have suffered if you were actually to walk away. So that's fine. Ashanti Gold tops up their account. Gold goes to $350. Gold goes to $370 during the next period. The exchange says you guys need to top up your account again. Gold keeps on climbing and climbing and climbing. And because they've hedged such a large percentage of their production, the position with the exchange is such that every day they're parting with millions and millions of dollars. Now, this is a strange paradox, because Ashanti Gold during this time is profitable, highly profitable. They've got cash costs of $200 an ounce, and the gold price in the market is now up to $400 an ounce, say. So they're a highly profitable company, but they have to file for bankruptcy because they can no longer afford to meet those margin calls from the exchange. If you cannot afford to meet your short-term liabilities, you're insolvent, basically. So that's how Ashanti Gold became insolvent, by doing the right thing, in effect. So I guess that story just explains two things. The clients don't typically want to hedge, and there are dangers in hedging too much. And especially if you're looking at a project that's already weak, you don't want to pull the same stunt that Ashanti tried. Let's hedge 100% of our production because we're just above the water, and let's lock in these prices at 100% of our production. So you can't do 100% of the production. What do? Do you do 50% of the production? Well, in that case, what happens if market prices tank? You're only covered for 50%, but you've got a weak project and it's bleeding cash on the 50% that's unhedged. So what do? So in this situation, if it's a weak project, hedging is not going to solve your problems. In fact, it could make your problems significantly worse. Because if the company then goes bankrupt, it needs to still fulfill its obligations under the hedge. And if your lender's in that project, it just means that there's more claims chasing the same amount of assets. So if you hadn't have hedged, there wouldn't have been those claims, but now there are those claims on those assets. And you get something that's called right-way risk, where in actual fact, if the gold price goes down, then the hedge provider will actually pay you. So it's very paradoxical, and it's very sometimes counterintuitive that the gold price could do very well and you're losing money. But the gold price could do very badly, but you're making money. So the moral of the story is hedging won't fix all of your problems, and you just need to understand all of the complexities. Why not to hedge at 100%? And just to understand that, it's not a good idea to try and fix your problems with just hedging. The next consideration is how well do you know the commodity? Okay. Is it opaque or is it clear? And just after this point, if you have any questions, just feel free to unmute and ask. How well do you know the commodity? Is it opaque or is it clear? Do we know how it behaves looking at history? Or is it something like mineral sands? Mineral sands is opaque. It's not clear. You can't really see how the market dynamics of supply and demand work in the mineral sands industry just because there's so few players in the industry and the cost curves are very expensive. And even the firms that are doing the research on the cost curves, there are not a lot of firms that are looking into the industry. So it's a lot of closely guarded secrets with regards to the level of demand and level of supply and cost curves. So as a bank, because you're not a player directly in that industry, to try and hedge mineral sands, there's no liquid market for it. So if you try to hedge it, the margins are going to be considerably high, meaning that let's say the forward price is sitting at X. In order to hedge, the bank is going to say X minus a large amount of margin just to protect themselves, just because it's very illiquid and unknown. Or is it something like gold, where it's a very clear market and you understand supply and demand because everybody's into gold? In which case, if you understand the commodity well, then maybe there's a better case for you to hedge. Versus mineral sands, the only hedge that you have in mineral sands is your cost structure, I guess, protecting your profitability margins. So you need to make sure that your operations are sound. Maybe you can do a little bit on the foreign exchange, but the actual commodity hedging, very difficult in that sector. Is it very liquid? The more liquid the commodity, the cheaper the hedging. So for gold, your margins would typically be quite small because it's a very often traded commodity. There's no real risk of the bank taking delivery of your gold and then not knowing what to do with it. So the bank can easily back it out, and the traders do that. That's what a trader's job is. The bank receives gold, and according to your mandate as a bank, you can't hold a speculative position. It's against the regulations. So you can't actually hold the gold. You have to, at the end of the day, you have to clear your position so you're net neutral. So your traders then have to sell the gold, and they can either sell it to somebody who wants to take delivery of the gold, but they've done that well in advance. Even when you wrote that forward contract for delivery next year, basically your traders hedged out that position a year ago. So that's what their job is to do. Given the question above, is hedging expensive? In other words, is it liquid? Is it an opaque market, or is it a clear market? And then you have to ask yourself, is the hedge relatively expensive then? Is your client thinking, well, it's not worth my while. If the bank is going to take these huge margins, I might as well take my chances with a free market. And that's what your clients are thinking as well. Okay. Are you hedging to protect debt serviceability or some other objective, as we touched on in the beginning? Okay. You need to understand what's happening in the mind of your organization, if you're a bank or an advisor, and the management of the company. And then you start your negotiations from this point. Okay. So you need to know what they're thinking and what you're thinking, what you want to accomplish, what they want to accomplish. If I'm a bank, I want to protect cash flow so that you can pay my debt. But I know that they're coming from a point that they want to remain unhedged so that they can take advantage of potential price increases in future. So I know what their objectives are. I know what my objectives are. So I can start the negotiation process from there. And maybe the client does not want to hedge at 20%, but there are many other structural things that you can do. Instead of a hedge, why don't we do a cash sweep? Okay. Now, a cash sweep is where you say the cash that's left over after you've paid all your contractual debt service, paid all your suppliers, your laborers, you're going to take a percentage of that cash to pay off the debt. A cash sweep acts like a hedge. It's a quasi-hedge because when times are good, you will then sweep cash to delever the deal, to bring the debt levels down. So debt goes down when times are good, such that when times are bad, the debt is now at a lower amount and it's protected you as lenders because you've reaped the benefit during good times. So a cash sweep is like a hedge. Um, and you need to understand, okay, hedging tenor can vary and so can structures. I think that's the basic conclusion. So to answer my student's question, you need to ask more questions. There is no stock standard approach, but I hope this slide gives you some questions to ask before you arrive at a solution. So it's going to be back and forth, and there might be some negotiation between you and the client, but at least you know what questions you need to be asking. Okay. The last thing that we're going to cover is what is a prepayment, what is a royalty, and what is a streaming transaction. Okay, so they're exactly the same thing, all three of them. They're just variants of the same thing. With a prepayment, I'm an off-taker for your product. So using the same analogy of gold, I want delivery of your gold. So what I will say is, I know that you are still constructing the mine. I will pay you today, and I'll give you $20 million. And in return, when you start producing, you need to give me X amount of ounces of gold. And the number of ounces are calculated such that I will get an implied interest rate. So let's just try and do an example off the top of my head with round numbers. Let's assume that you're going to give this company a very small example. You're going to give this company $180,000 today. And in the future, all you want is 100 ounces of gold. Okay. So the gold price today is $1,800. Basically, the company is going to deliver 100 ounces to you in a year's time. And that represents the money that you gave them today, you just prepaid. But can you see, if you do it on those terms and conditions, you make zero interest. So you've paid 180,000 ounces for 100 ounces. The implied gold price then is you have just bought gold for $1,800 an ounce on day one. And then you will then receive 100 ounces 1 year into the future. So you made 0% interest. What if you change the deal a bit? You say to them, I will give you $180,000 today, but in a year's time, I want 110 ounces of gold. So now you see that we can think of it two ways now. The current gold price is $1,800. You get that today. And at $1,800 an ounce, you get 110 ounces of gold. Okay. So in the future, if the gold price stays the same, you're going to get what's 110 times 1,800. That is 12800. So you're going to get like 120 something thousand dollars worth of gold. So that represents your interest that you earn on that transaction. Okay, so your delivery, the number of delivery or ounces you get delivered at the end of the day implies the rate of interest that you're going to earn on this prepayment transaction. And how it would typically work is once they deliver those 110,000 ounces, you will then advance another $180,000 to that company, and you'll roll it on a 3-month basis, for instance. So you'll give them enough money for 3 months worth of production. Once they deliver, then you roll the same amount of money, you advance the same amount of money, such that it's ongoing. They repay you, and then you advance again, repay and advance and repay and advance. And that's how a typical prepayment arrangement would work. For a royalty, it's the same concept, only you pay on day one. And then what happens is the mine owes you a debt over a certain amount of years. So the mine will say, I'll give you 1% of my production for the next 10 years or for life of mine. Okay, so that's a royalty. You pay once today and the mine delivers the gold to you, a percentage of the production for a long time into the future, sometimes life of mine. The third variant, a streaming transaction, it's exactly like a royalty, but only you pay the mine on day one, and the mine delivers a percentage of its production to you, but you just have to pay a discounted price for that production. So let's give you an example. I enter into a royalty agreement. I give a mine $10 million, and I say to the mine, in return, I want 1% of your production from now until the end of your mine life. Okay. With a streaming arrangement, I can say to the mine, okay, I'm going to give you $10 million, but this time I want 1% of your production, but every time you deliver to me, I'll give you $1,000 an ounce of gold. So I'm getting gold at a deeply discounted price. If the current gold price is 1,800, when the company delivers to me, I only give them $1,000. So you can think of a streaming transaction as I've paid a deposit for that gold on day one. And when I receive the gold, I just pay a reduced price, taking into account that I gave them a deposit on day one. And you just need to do the mathematics to see which option would be cheaper. And there are very interesting ways, or very simple ways, to model that if you look at that in your financial model. Okay. Ordinary course of business, funders providing such prepayment facilities are the first to be repaid before all creditors. So this is quite important, because if they are off-takers, when you deliver the gold, the only way that you're going to get your money is you deliver the gold to me and I say I want 1%. So I deduct that 1% and I give you the net proceeds thereafter. So when you do your income statement, it'll be gross revenue minus royalty, net revenue. And after net revenue, then everybody, salaries, taxes, everything falls after that net revenue. And that's why governments also like to take royalties from your top line, from your gross revenue. Governments like to charge you your royalties at that level because they get the bite of the apple before everybody else. Okay. But you need to bear in mind, and we cover this in the mining finance course, in the case of a liquidation, these type of funding structures are usually unsecured. So you don't have any collateral and you rank behind senior debt in priority of payments. So your recoveries in the case of a liquidation are significantly less than the senior debt. Even if you are super senior, even if you're ranked above the senior debt, because remember, it's revenue, then you get your cut, and the senior debt is only paid after net revenue. So you're super senior in the ordinary course of business, but in a liquidation, when you want to attach the furniture, the cars, and all the assets, you have to wait until the senior lenders are made whole for you to make a claim in that case. And such facilities usually have weak rights to call default. And consequently, they're considered to be relatively high risk and therefore quite richly priced. They do not cause any dilution of ownership. So unlike shares, where you raise equity funding, the more shares that you raise, the more your company ownership is diluted. The more royalties you have and prepayments and streaming you have, it doesn't cause a dilution of equity, but more importantly, it causes a dilution of earnings. Because everybody else now gets net revenue, not gross revenue. And let's say you've written a large royalty agreement, and that's 10% of production goes to the royalty provider. It means that everybody essentially has lost 10% of the income of the company from the top line, which is quite significant. Okay, so you also need to look at issues like dilution. When you are a bank or a lender and you are asked for approval, the company wants to raise a royalty facility, you need to look at the implications on you. Although they might not have a direct claim on the assets, they cause earnings dilution for you as a bank, and they may prejudice your position as a senior lender. So I'm just going to close off with something interesting that I watched recently. You know, gold is still flavor of the month despite the sell-off in gold. And I was watching a presentation by a royalty company, and they are of the view that royalty companies offer very lucrative alternatives. So in a previous discussion, I asked, I just opened up a question that would my students prefer to invest in physical gold ETFs, shares in gold mining companies? So I can just add this alternative. would you invest in a gold royalty company? Let's think of what that entails. You have a company that is receiving production from producing mines. They're receiving 1% here, 1% there, 2% of this mine's production. So they're actually receiving physical gold. So you have direct gold price exposure, and the company actually owns the gold. So it doesn't have the disadvantages of an ETF, where under an ETF, some ETFs just reference the gold price, but you don't physically have the gold. So if the ETF goes bust, you don't have a reliable store of value that you can go into the vaults and say, this is my gold. It's like buying an index. It's like buying shares. It's speculators can just drive up the price. But if the ETF references the gold price, you know what the price is, but you don't actually own physical gold. Okay. Gold is seen as safe haven, so it's free of that manipulation. So you actually want the physical gold. So that's why some people don't invest in the ETF. But by the same token, if the thing pays you a certain payment based on the price of gold, so it's like owning gold, but you don't have to pay for the storage costs, you could argue that point. But you do pay for the fees of managing the ETF. Okay, so you are subject to that. Not storage costs, but the ETF costs. And you just need to weigh up which ones are more expensive. But let's look at the royalty company, where it's like the company owns the physical gold. The company doesn't have to worry about any of the things that a gold mining company worries about in terms of operational risk, not at least directly. Once the mines that this royalty company is collecting royalties from, once they produce gold, the royalty company gets the first bite of the apple. Okay, so it doesn't matter what the cost structure does after the royalty company has taken their share. The gold mining company, from net revenue, then you have your operating cost structure. And all of those risks are not your problem if you invest in a royalty company. You do indirectly take the risk of the bankruptcy of the actual underlying gold mine, but now you've also got diversification. So maybe the royalty provider has got 10, 20, 30, 40 gold companies, and you've got that diversification instead of owning an ETF for 10, 20, 30 gold stocks, or instead of owning a share for one gold company, or instead of earning nothing by holding physical gold. So just a little bit of food for thought just to add to the discussion. What are your thoughts? You can leave a comment on the comment space below or in the LinkedIn group, and we can continue that discussion. Just join the LinkedIn group, join the discussion, and till next time, subscribe, like, and see you guys next time.